All right. Hello. Hello. This is Abel Pacheco, your host for the Five Talents podcast. We are super excited today because we have Mr. Jon Siegel with us. Jon, thanks very much for coming, man. How's it going?
Great, great. Thanks for having me. Really appreciate it.
Yeah, I appreciate it. I'm excited to have this conversation because we're connected as both attendee speakers on some real estate development news and the read articles and read panels. And I was like, man, I asked my team, is there anybody worth interviewing? And they go, Jon is the man. Let's interview them for sure at RailField. So Jon, if you don't know Jon, let me introduce him real quick. He is the chief investment officer and co-founder at RailField. And man, they've got a tremendous portfolio and track record background. They've done about 21-ish properties, 5,000 to 6,000 doors total, plus a number of exits, really $500 million of assets under management. I mean, this is a remarkable portfolio. And we have the opportunity to hear from Jon and figure out how in the world did he do that and what's going on today. So anyways, Jon, thank you very much. If I can turn it over to you, man, just a quick introduction. Tell us in your own words who you are and what you do, and we'll start a great conversation.
Yeah, no, that's awesome. Again, appreciate you having me. Jon Siegel, and I'm here actually in the DC area. So we met down in Austin, and we've done a lot of deals in Texas, but we're based outside of DC here in Bethesda, Maryland. And RailField's our company. We've been around for about 9 years now. I'm actually originally from here in the DC area. Grew up here, but went away to go to college and to grad school, and somehow found my way back here, and have lived, in this area now for 30 years or so. And I've been in the multifamily business for a long time now. So I don't know if people can see me, but gray hair starting to show, and maybe that gives me a little bit of wisdom.
Yeah, man. So how many years in multifamily? Maybe all in, include professional experience, working as an employee, all the way,
Yeah, I'm probably pushing about 30 years in multifamily.
Oh man, that's awesome.
Yeah, I actually fell into it. I actually had a job way back when. I worked at a radio station, and I was making, like $2 an hour or whatever. And my parents were like, when are you going to get a real job? And they're like, why don't you talk to this other guy, this guy we know? And so I went and talked to him, and they were in the multifamily business. They owned apartments and they had a management company. He said, I don't really need anybody, but if you want a job, I'll bring you in. So I started working there. That was back in the late 80s. Worked there for 2 years, had no idea what I was doing. Decided and I was a history major in college. So I was like, if I'm going to do this business thing, I probably need to learn a little bit more about business. So I went back to business school and got an MBA.
Okay.
And so when I got out of business school was actually during a huge recession, the sort of early 90s. Was a really lousy time to find a job. But because I had worked in multifamily, I was fortunate enough to actually get a job. And it was a company that was actually the largest owner of apartments in the country. It was here in the DC area. And so they hired, they were actually, this will show my age, they were buying a lot of bad loans. So when the savings loan crisis happened, and there was the RTC, they called it, and that's what they were taking all the old savings loan assets and selling them. And so people were buying, pennies on the dollar, buying apartment property, $2,500 a unit or whatever. And so they were looking at a lot of deals. So that's what I started doing, and started underwriting apartment properties and really sort of knowing the financial side of it. And so I worked there for a while. I was an acquisitions guy. And I would say that the company was, it was actually owned by the endowment of Harvard University. So it was really well capitalized. But for some reason, they let me, this guy in his 20s, do a bunch of acquisitions. So it was a great experience for me. I'm not sure I would have allowed myself to do that.
Yeah, here you go. Here's the hundreds of millions of dollars. Go buy some stuff.
Yeah, exactly.
Make sure you analyze them.
Yeah. What is the advice somebody always gives you is, always make your mistakes with somebody else's money. So, that was my experience with that. And that company actually, interestingly, I was an acquisitions guy. And one day we were going to buy a REIT. So they said, we want to buy a REIT. We want to grow the company. So we were looking at the REIT, and then there was a big meeting one day, and it was above my pay grade. So I didn't go to the meeting. I went back in the next day, and I said to the CEO, what happened at the meeting? He's like, slight change of plans. We're not buying them. They're going to buy us. So that company ended up getting sold. And so when you're the acquisitions guy, that's pretty much the end of the line. So So it was a great experience. And then from there, though, I went from being on the principal side to being a lender. And I started working at Fannie Mae, which was, again, I really had no desire. I thought Fannie Mae was going to be this big bureaucratic government agency. And I was like, it's not for me. Ended up, they approached me when I was leaving NHP, and they said, and they have a group that did, and they still do, large transactions. So when a REIT or a big fund or something does, a couple $100 million of in financing, somebody from Fannie Mae has to do that deal. Typically, Fannie Mae loans are done through a lender, and Fannie Mae doesn't really get involved. And they said, we need somebody to do these deals on behalf of Fannie Mae. We need to be ready. And so I ended up doing that. And I worked at Fannie off and on for till after 2010, doing that. And I also was the person that started the student housing. So a lot of people who do student housing get loans from Fannie Mae. When I started working there, they actually didn't do student housing. That was sort of forbidden. And I was sort of like, why would we not do this? And so they were like, well, if you want to do it, come up with a plan. And, so I did a plan. Kicked it off, man.
Kicked it off.
Yeah. So I was a lender. And then, but Fannie Mae is a huge company, and it was a good place to work. But I was starting to approach middle age, and maybe saying, I gotta try something different, and really had that entrepreneurial bug. I had on the side, going back, probably 10 years, I had on the side done a bunch of smaller deals. So I had bought smaller, like single family rentals, a couple of, small multifamily, had sort of cobbled together some deals and had always done it on the side. And it was actually a really poorly kept secret at Fannie Mae. Everybody knew I did it. And at one point I told them, because I had to get financing and I didn't want to get in trouble. And so I had done it. So I had the entrepreneurial bug. And one of the guys who's one of my partners now came to me one day and said, hey, what you're doing, I'd like to do that too. Will you show me what to do? And I said, sure. And so we started talking about it. And then, after one horrible meeting at Fannie Mae, we were like, we should just go do this for a job. Then, just go. So long story short, we left Fannie and we started doing started trying to do it. And we got a few deals going. But this was sort of during the great financial crisis, so not the greatest time to start a company.
A little bit. You took your licks. You took your licks and you kept going.
We took our licks, and the other thing we had going for us was that we had been in the business. We knew a lot of people, and everybody came to us and said, "Hey, will you help us do this? Will you consult for us or whatever?" So we ended up making enough money doing consulting gigs and advisory work. Which actually turned into a pretty good business for a while we were, getting the property thing off the ground. Fast forward to around 2013 or so. And the guy that we worked for at Fannie Mae is a guy by the name of Ken Bacon, and he ran multifamily at Fannie Mae. And he decided to leave Fannie, and he was going to figure out what he was going to do. And he's on the board of a company called Artemis Real Estate Partners, which people may or may not have heard of. It's a big real estate private equity firm. And they had gotten a lot of money from some pension funds, and they had said, and the pension funds had told them, you need to invest some of this with a smaller manager. You're giving it to the same 8 people that you always give the money to, the same big boys. And they were like, And so they wanted to, they were trying to think of a small company, and they yelled, and Ken's pay for being on the board there was to sit in their office. Basically, he had an office there. So they yelled across the hall, "Hey, Ken, you ever think of starting a multifamily company?" And he goes, "Nah, I don't really want to raise money." They're like, "We don't have to raise money because we have money." And so he's a big shot. He's not going to do like a memo or a spreadsheet or something like that. Todd and I, he goes, you guys want to start a multifamily company? We're like, well, we already did. So he goes, well, I think we could get some pension fund money. So that was the beginning of RailField. That was a long-winded response, but that was sort of how we got to where we started this company.
Oh, that's awesome. No, it's really good, Jon, just to hear, like a normal, everyday, average individual, if I can say that about you. When you were younger, making $2 an hour at the radio station. And then, no business degree at that point. You're like, well, they fell into this multifamily thing. Making the decision, there are a couple of things that I heard, right, was making a pivotal decision on, I got to go get some education. I got a great spot, great opportunity. Let me go get my MBA. So, gloss over that. When you're younger, discipline, hard work, time, effort, energy, money, all the things that you have to invest in yourself to come out with the education and then say, oh, I'm going to move forward on this. So that was awesome. And then, good time to start. Some people may say, oh, in a crisis time.
Yeah.
But yeah, you were evaluating companies pennies on the dollar.
Yeah.
And so what better opportunity to say, oh, all these deals are falling apart and I'm with a team, a company that can actually make a move. So they were in a liquid position. So it gives you the opportunity to, hone your underwriting, your acquisition, your analysis, and just kind of learn on someone else's dime, right? That's amazing. It's awesome, man.
Yeah. I think I started both the heart of my professional career working for somebody else and also my entrepreneurial career, both times in a financial crisis. So it was great timing, but I'm stubborn enough to keep going with it. So
here we go, man. Here we go. And that, to be that entrepreneur, the business owner, the person to launch a new idea, whether you're selling a product, a service, an idea, you're starting a new company, the stubbornness and the willingness to not give up when things get really tough is a common thread, a common theme that I hear from a lot of individuals. It's not without challenge. You're going to get your licks, you're going to get hit, you're going to get knocked down, but you have to keep going. When we keep going, success is on the other end.
Sure. Persistence is 100%. That's, if you were to say, what is the biggest trait that you need to have to do the entrepreneurial thing? I think it's persistence.
Yeah, get after it. And then, landing or having the opportunity to work at, Fannie Mae and starting new programs. I mean, that's awesome. Starting the entrepreneurial side in your middle age is kind of, you had mentioned. So, you started this portfolio, the $500 million of assets under management. And for those that are listening and not really sure what that means, there's a portfolio of apartment complexes, 13, 14 deals at this point, all of them $200, $300. They were probably in different ranges, hundreds of millions of dollars, $500 million. And the team goes and manages the property from the asset level, financials, projections, plans, execution. The property manager is doing their thing. But, really John and his team, acquisition, disposition, just really managing the assets, right? The portfolio. So that's quite a run in 9 years. That's amazing, man.
No, we essentially started with a blank piece of paper and, we were really lucky that we got, we got institutional capital. So I think most people that start, and when I told you I did some deals on the side and stuff, that was more, friends and family are just trying to cobble it together.
Yeah. I forgot to mention this because as a single family, one other common thread is that a bunch of people are just like you and I were like, you were in multifamily, but you were still buying some single family properties on your side.
I can afford.
It's just like, what can we do? Right. And that's a common thread, among a bunch of multifamily guys. Sorry, cut you off.
And most people, I think most companies like ours that start, they end up starting, raising money from friends and family, or maybe some rich people at the country club or whatever it is. Sure. We actually we're sort of the opposite. I mean, I guess we sort of started on third base, and that we got money from a pension fund, which is what a lot of people want to do, as a goal, as instead of a starting thing. But it wasn't. So when we started, we got the money from the pension fund. They said, okay, we'll give you $50 million if you give us a business plan. And bear in mind, we're sitting here in Bethesda, Maryland, and they said, give us a business plan. If it was to say that you're going to buy properties in Texas, you'd have a pretty good chance. So we're like, of course, we're, the foremost authorities on properties in Texas. And I have over the years, I think I've done a deal in everywhere because I work for these big institutions and stuff. So we had plenty of experience dealing with Texas, but it was sort of interesting. We had three guys sitting in a room in the DC area, and we ended up starting buying properties in Texas. And and so we ended up, we had to go down there basically because we had not been focusing on that. First of all, we'd been lenders, and then in our earlier stage of starting this, we have been focusing more on here in the Mid-Atlantic, and so we basically had to go down to Texas and get a lot of miles in Southwest and go down and meet with every broker and drive all the properties and really start to get into the market. And obviously, it helps if you say I have $50 million from New York Common, the pension fund, but
Make
but
a
yeah,
little
that
easier for a
was a
broker
lot
to
of,
take you seriously. Maybe
yeah,
make it a
that
little
was a lot
easier.
of effort. And actually, we, because we've been in this business a long time, we know a decent number of people, and we actually called on some people that we knew, and one of them was the head of a REIT, and we said, hey, we're looking for some deals. He goes, hey, I have a deal. If you guys can make the number, I'll give it to you. So we looked at it, we did a little model. We came up, we're like, okay, yeah, we can do it. We went back to our guys who had given us the money. And we said, hey, we're looking at this deal. They said, yeah, we'll throw in an offer, see what happens. Well, I don't think they realized that we actually knew the guy that ran the company. And so he called us back, said, okay, yeah, we're going to give you the deal. So we called our guys and said, hey, we got the deal. And they're like, you got what? No, we're not ready to start yet. So we got a lot of egg on our face. We had, called in some favors.
Yeah.
But yeah, so we ended up, the interesting thing is we ended up buying a couple of properties, spending the money with the pension fund. And we kind of naively thought like, hey, we got this money from a pension fund, we'll spend it and we'll just get a whole bunch more money from a pension fund, and this will be really easy. And then we'll be a huge company and we'll all be rich, right? Well, it turns out that most pension funds actually don't want to do business with three guys sitting in a room that have, three properties in San Antonio or whatever. So we basically had to start, I would say start again, but we had to sort of retool ourselves a little bit and adjust the strategy.
So, well, man, that's a great start. So I think this is
Yeah.
a good opportunity, right? Because our show, we focus a lot on multifamily as the vehicle to create wealth, right?
Yeah.
And we're trying to build wealth, like the 1%. And here we are, pension funds, that they're large, amalgamation of different investor funds, all trying to do the same thing. We're trying to make it earn. We rarely have people that are, pulling a big amount of capital from institutional sources. You guys started right off the bat, obviously different time and place, et cetera. You guys had a ton of experience at Fannie and all working together, know all the right people, et cetera. But maybe you can talk about it today. Like what does an institutional capital source require today? How do you meet with them? What do they want? What are you delivering? And any and all of the above is going to be great information for us.
So interestingly, in our life cycle of our company, as I said, we started with some pension fund money, we spent it, and then we thought we'd get more, and we couldn't because we didn't have any. They were like, "Well, you guys don't have a whole much of a track record." So we actually ended up getting money from some family offices and using some contacts we had with some other institutions. And long story short is we have just got some more money from a pension fund. We sort of got back to it, and so but what it takes obviously is, well, we talk about persistence. It takes a long time. If you have a deal and you raise money, say you have a deal and you put it under contract, okay, I'm going to call everybody I know and I'm going to raise whatever I need, friends and family, or in $100,000 chunks or whatever. That can happen pretty fast.
Yeah, which is what we do today, right? Yeah. We're on a number of acquisitions. We've acquired for us about 16-ish deals. We're working together in a syndication, and we all pull capital, and that's what we're doing with friends, family, people we know. 50 to 100K, and that's like, wow, so money comes in a short period of time, 30 to 60 days. We got to fill it out. Here's $5 million, right? But,
right. And so with the institutions, it just takes a really long time. You go have a meeting with them. They're not going to say, you're going to meet with them on Tuesday. They're not going to say on Wednesday, like, here's some money, go for it. It's going to take a year, 2 years. We talked to one group for 5 years before we actually got the money.
Difference. A little bit of a difference right there.
So I mean, the differences between the two are probably, between raising money from friends and family or just, from more high net worth investors versus the institution is, obviously you're going to have to put together the money, piece by piece, where if we're looking at a deal now, we have we have a document signed and we know we have the money if we can make the deal work. So you're going to do that. You're going to get, your fees are going to be different. Your promote's going to be different. You're probably going to you may have a little more autonomy. It depends. I assume that when you have a deal, if you like it and you have conviction behind it, you tend to go out to people and say, hey, this is a deal, I believe in it. And they're investing as much in you as they are in the deal. Right?
Yeah. We're moving forward. Right. If we're like, hey, this is a good deal.
Yeah.
Like, figure it out one way or the other. Right.
And so we, for the most part, have to if we have a deal, then we go back and we have to show the people at the institution, like, here's the deal. Here's how we looked at it. Here's the model. Here's all the stuff. And then we want that. And then they're going to generally say, okay, we're okay with it, go forward. So we don't have always, it depends on the group. We do have one group we work with where we have a little bit more discretion, but for the most part, we have to go back and ask permission. So that's kind of the negative side of that is, we have somebody sort of watching over our shoulder a lot more, and we have to report back to them, quarterly. And, some of them we have weekly calls where we go over everything we're doing.
Yeah. All expectations set in advance. You've courted them, they've courted you. You're setting expectations during that process. Here's the guidelines of properties I'm looking for. Here's the return. Here's the model. And then, it's like, okay.
Yeah. So
profit's ongoing, right?
Right. So what happens is, we tell them what we do. They tell us what they're looking for. If there's a match, then they'll do a lot of due diligence on us. They will, we had one group that we just signed a joint venture with that we're doing, $100 million with, hopefully. And they came and they looked at the models for all the properties we bought, and they went through how they've performed, and they did background checks on us, and we had to give them a lot of references. They did a lot of homework on us to make sure that we were who we said we were going to be. And then once we had an agreement that we're going to do something, then we set up a box saying we're looking for value add properties in these markets, and these are the types of returns we're targeting. And if we find the property and we buy it, then here's how we're going to split the money and what fees they're going to pay us and what our promote is and all of that. And then we have a box, and then we spend a lot of time and money negotiating, agreements before we've ever bought anything. Yeah. And then once that's done, then we go out and go shopping. Now, it's easier for us on a lot of deals, I would think. Again, I could be wrong about this, but we perceive this, and we hope it's the case. It's easier for us sometimes to win a deal, say if we're going up against somebody that's going to syndicate it, because we can say like, hey, we have
my backer. Go call them.
Yeah, here's I have the money. I'm ready to go, and I can move really fast. And sometimes I don't even need to get a loan. I can just, I can close it all equity and then put a loan on later, something like that. So that's our advantage on that. But yeah, it's a long process, and let's say the grass is sometimes always greener. There are definitely days that we wish, like, oh God, I wish we just didn't have.
Like, why am I dealing with this partner?
Yeah.
I just deal with 30 people that don't call me. Right?
Exactly. I mean, they tend to be nice guys and all of that, but everybody wants to call their own shot.
Awesome. That's awesome, man. Well, there's pros and cons to everything, and it's definitely a model, and it's good to hear, that you're having a lot of success with it, man. Congratulations. Also on the institutional capital, right? The big check writers, larger. There's a difference. When we do a syndication, we typically have a $50,000 minimum investment, maybe $100,000 on a big deal, and we've got a number of partners coming in as LP, passive, and but on your side, there are probably minimums, but it's more like minimum to place X amount of capital, right? Maybe you can twist the mindset a little bit. It's not a 50K investor. It's a minimum of X amount of deal size or whatever. No, it tends to be more a discussion around like what kind of check size are they looking to write. And a lot of times, sort of the opposite of that is they'll say the check's too small. And so it really depends. We actually had some success recently with a group who said they wanted to do small deals, but small deals for them was something between, maybe $10 and $20 million check instead of, 20 million plus. Yeah, just a small deal, 50 million, right. 20 million, 20 million in equity, and no, just go find one of those deals.
Right. And interestingly, we have one group that wants to do $10 million. That's sort of their number. They like to do a $10 million check.
That's their minimum for those that don't know, like we'll explain it to you a little bit. So larger check writers, if you're trying to place 50 or $100 million this year, it's kind of difficult for them to reasonably say, I vetted out a bunch of partners and I'm going to put $1 million in each one. More likely it's like they need to figure out those big chunks, and they've got to be able to put like $10 million as a minimum because they may have 10 deals they're trying to do. Exactly. And so that's why they have like a minimum. And so John, maybe you can elaborate on this mindset.
Yeah. I mean, the saying that we always have is that you can spend as much time on a $1 million deal as you can on a $100 million deal. And so, there's a certain amount of money that people want to put out. And when they put it out, they want to put it out in bigger chunks because it's just more efficient that way. And the other thing is that a lot of time, the kind of assets that the institutional guys look at sometimes are different from the kind of assets that the syndicators look at. So we have had a lot of deals, especially in Texas. Texas has a very robust ecosystem, I guess would be the right word, of syndicators and a lot of people that are in that business. And there tends to be a certain type of properties and you can speak more to this than I can. Brokers are telling me that, certain properties like, look, there's going to be 100 syndicators on this deal. Don't bother. Versus other deals where it's like there's the institutional guys are going to go for this, and you're not. And so the institutional guys are going to oftentimes look for newer properties or bigger properties or certain locations versus other locations, where the syndicators, because they're doing a little bit smaller deals, also willing to take more risk, because there's also more reward there, are sometimes looking at maybe older properties or maybe different locations. And so, that's not hard and fast, but that tends to be, part of the equation is, we don't want to look at a deal like we had a deal, and this is not in Texas, but we have a group that we work with, and we've had a number of deals that we've shown them in Virginia Beach, Virginia, which is a pretty good market, but is a kind of a military market. It's actually a little bit sort of like San Antonio. It has a lot of military. It's a little more steady than like, say, in Austin, that's up and down. And then every deal we show them, which are good deals, they're like, yeah, they're okay. And then we have a deal in, say, Raleigh, Durham, which is a really hot market in this part of the country. And those deals tend to have a lower cap rate, but that's a really hot market. That would be the Austin of, sort of this part of the country. And
Sure.
you show them a deal there and they're like, yes. So they're sometimes driven more by, the market, the location, the size, things like that, than where you're going to be look at it more entrepreneurially and say, hey, I know this is a really good spot right here. I can make a lot of money here. I know I can, get the rents here, all this stuff. It may not be the sexiest submarket in the world, but this is a place where I know we're going to do really well.
Yeah.
Where the other guys may say, well, I won't look bad if, back to my committee or whatever, if I'm,
if I'm spending their money, I better better have a good case.
Yeah. So that's a little
awesome.
bit, when you're dealing with institutions, it's a little different in terms of, what they're looking for and how they're going to end up making a decision.
Yeah, there's there's an inverse, right? If you're listening and you're like, well, what's a 4 cap? What does that mean versus a 6 cap? And what's Raleigh and Austin versus McAllen, Texas, right? Tertiary market rate, primary. Well, the lower the cap rate, which is the lower percentage of, essentially return on capital, it kind of typically thought of as it's a lower risk proposition. And if I'm buying something at a higher cap rate, which is a lower price, it has more risk because I got to do more work. I got to do something to it to force the appreciation up. And, if I'm placing, again, $100 million this year, then it's really inefficient for me to go do this 2 million, 3 million, 4 million, blah, 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 as opposed to a nice, really big, beautiful, low risk asset. I can place 10 or 20 million bucks into,
Right. And also you're going to have the mindset where you have the mindset of an entrepreneur. And we do too, of an entrepreneur that's sort of like, hey, I know, like McAllen, there's a ton of demand there. That's a market that's always going to be full, and I can raise rents and I can do my value add. And it's a really solid market. And I'm putting my own money into it. And it's, so this is a great deal versus an institutional mindset where I'm sitting in, New York City and I don't know where McAllen is. I have to Google.
Like, where's McAllen? Yeah. What is that place?
Yeah.
Next to Brownsville, the Rio Grande Valley. What the heck are you talking about? Where's Austin? Where's Dallas? Where's Houston?
Exactly.
Right?
And I have to tell my boss that I did a deal in McAllen, Texas, versus I told my boss I did a deal in Dallas. It's that.
Here we go.
What we deal with.
That's awesome. That's awesome. Well, it's a good mindset. So really quickly on this, for somebody trying to build wealth, right? They're trying to figure out how to go. Number one, create wealth. The people that are trying to preserve wealth are in a different situation, but for those that are trying to build, man, what advice can you give through your years of experience and entrepreneur experience, your real estate advice, just kind of anything in general that you think somebody may really benefit from trying to create some wealth?
Yeah, I mean, I think the biggest things that I found in my, my career so far, and hey, I wish I'd like to build more wealth. But the biggest things I think are, one, do business with people that you trust, that you can trust, that have a good reputation. There's a lot of people in the real estate business and in any business that you can't trust, and there's a lot of people that are great people, and so you got to find the right people that you can trust, and people that know what they're doing. That's really important. And the other thing is probably just having patience, because I always tell the guys here that work for me that we look at a deal and they're like, man, they bought that property in 2010 for $60,000 a unit, and we're going to buy it now for $240,000 a unit.
Crazy.
12 years later, and I always say that's how you make money in real estate. Over time, it always does. And so there certainly are plenty of deals where you can make money pretty quickly, but we tend to look at deals here at RailField. We tend to look at things with a long-term perspective. That doesn't mean that we always have a long-term, execution. So a lot of times, people say like, how long is your hold period? And I say, well, we always underwrite a 10-year hold period. Now, we haven't even been in existence for 10 years, and we've already sold 7 or 8 properties. So obviously, we don't always hold it for 10 years. If it makes sense, that's what we do. And we're going to sell it as soon as we can to maximize the return. But if we look at it from a long-term perspective, at least we know that if there's a problem, we can get through the problem. Because I think over time in real estate, my experience over 30 years now is that over time, it always goes up, and it always does well. And especially if you have the right piece of real estate. So I think, having a long-term perspective and doing and getting into business with people that you can trust, those are probably the two things I think that have done well for me.
Great. That's great, man. Thank you for sharing. Things are really good. So in this time and place, before you go, a couple of thoughts, questions on debt and financing. Right now, what's happening if you're not in the know, it's October 2022. The Fed is moving interest rates aggressively, historically fast, and we are getting pummeled 75 basis points, 50 basis point increase. And what that essentially means is our, variable rate loans, or just the interest rates are higher. It means you borrow at a higher rate from the banks, which we typically get the most of the money from our lenders. And we want that as low as possible. If it's higher interest, that means it costs more money. That means we have to raise more equity to kind of, to fund it. And then also the loan to value is shrinking right now. Last year, a couple of years ago, oh, great. Last year, even we were getting really good 70, 75, 80, offers of, and now it's like 60, 55, 60, 65. So that also means you borrow less money from the bank. You got to raise more equity. It's harder to find deals. So what are you seeing, and what's going on, and any thoughts on the whole thing, man? Interest rates, what's going on?
Yeah, it's crazy. It's crazy times. I mean, I think the biggest thing that you just pointed out, and actually this, and then in the last topic we're talking about, is the difference that we have now is that the interest rates keep going up, and then the cap rates, as we keep talking about, the cap rates as a metric of what your return is, are going up, but maybe not at the same pace. And so typically what you want to have, if you just do simple math, is you always want your cap rate to be higher than your loan rate. Otherwise, that's what they call negative leverage, because you're getting a lower return than your debt payment theoretically. And so what we've had what has happened in the market is we have a disconnect where right now in a lot of markets we have this negative leverage, which really just means that probably not a lot of acquisitions are going to happen because it doesn't make sense mathematically to do it. And so, so we have a big, what they call the bid-ask spread. So if I'm selling a property today, I'm fixated on the price because that's what I was going to get 6 months ago before the rates went up, and I don't want to let it go for less than that. But if I'm buying a property today, I'm like, man, I can only get like 60% loan to value, and the rate's 7%, and it just doesn't make sense anymore. I have to do it for this price. And so that's kind of where we are in the market. Is I think there's a big spread there. Certainly there are deals getting done, but there's a big spread there. And the other thing is that you have a lot of uncertainty if you're doing acquisitions. You just have a lot of uncertainty around the rates and what are they going to be. And so it's hard to go into a deal and say, okay, I'm going to pay this price for it, because one of the big inputs in determining the price is what your debt's going to look like. And so if I go in and I assume like, there are deals we're working on that we were talking about 5 months ago. And then we came back and they sent us the new numbers and they said, where are you guys today? And we said, we're here. And they said, well, you're a lot lower than where you were 5 months ago. It's like, yeah, well, because the rates are so much higher. And it becomes a little bit of a math problem. And so until we sort of have a stabilizing of the rates and the prices, we're going to have the disconnect there. And we're also not going to have the certainty, what I would call the certainty of execution. So if I'm selling a property, I'm worried that the guy's not going to be able to close. And if I'm buying the property, I'm worried that my deal is not going to look the same. And so what we have done here and what, other people might want to think about doing is we've looked at loan assumptions. And so, people have gotten loans over the years. They got loans when rates were low. And especially if you have, a Freddie Mac or Fannie Mae loan, those loans are assumable. And so we have a deal that we're buying now where actually when we were talking to them, the rates were bouncing all over the place. And they're like, we don't know that you can execute or whatever. And we said, well, what does your loan look like? And they said, here's, X, Y, and Z. And we said, hey, that works for us. So we're assuming the loan. So that took all of that out of the equation. We knew exactly what our loan was going to be. There's no question. It doesn't matter where the rates go. They go up to 100%. It doesn't matter. We're stuck where we are and we're getting the deal done. So that's something to think about. Otherwise, there's just a lot of uncertainty right now. And I think a lot of people, and when we talk about the institutional space, a lot of the institutional guys are sort of on the sidelines a little bit saying like, we don't really know what to make of this.
Yeah. We had a deal fall through. We were doing a sell and buyer couldn't execute with the lender and terms changed too much since we weren't under contract. And that was a drag. And we had another, opportunity where, it worked out kind of in our favor where the purchase price came down because we said, hey, the LTV changed, the interest rates changed since we were under contract. We're going to need a little help. If you want us to close, we need a reduction in cost. And so that kind of helped out a bunch when they knock it down a few $1 million. That never hurts.
There's
never hurts.
No shame in that now. Yeah.
But it's kind of like that certainty of execution. If you can figure out a way to get a assumable fixed rate loan, it's like, oh, okay. Maybe a year and a half ago, maybe 2 years ago ish, we're looking at deals and we're like, oh, we're not going to assume that at 5, at 4.5, 5, no way. Now it's like, oh yeah, it looks really good.
Yeah. We bought a property in San Antonio last year where our rate is like a fixed rate of 2.9% with 10 years of interest only.
Crazy.
Yeah. And now that same loan would be, high 5% probably, something like that. So it's all changed. But I always say that's one thing about the market is it always changes and people are always doing deals and there's always, as long as you can adapt to it, you might have to be a little cautious for a short period of time. But we tend to always say we're always in the market because there's always an opportunity. I mean, there's 20 million apartments in America. There's got to be something that would make sense.
20 million. There's got to be a couple opportunities out there for some individuals that want to move forward, right?
Exactly.
Well, good, man. Well, Jon, thank you so much for your time. If somebody wants to reach out to you, who do you want to reach out to you, and where should they go contact you in case anybody wants to connect and get in your world?
Yeah, well, I was saying in our business, we're always looking for deals and money, I guess. So anybody that has a transaction they want to discuss or just wants to connect, I'm always happy to connect with anybody. And the more people we talk with, the more people we connect with, the more opportunities we find, and the more we know, which makes us better at what we do. So you can always email me, JSIEGEL at railfieldrealty.com. Or you can just go to our website, RailField Realty. I think we have a contact us thing if that's easier. But yeah,
all right.
I'm always love to connect with anybody in the business and compare notes and see if there's something we can always do.
Yeah, I appreciate it, Jon. So, well, the last couple of minutes, is there anything, we didn't talk about, something you were hoping I asked and I just never got to? Any last words to wisdom in general, man? It's time and space is yours.
Yeah, no, I appreciate you having me. It's always interesting to talk to different people in different markets and sort of with different strategies, and the sort of, at the end of the day, the properties are kind of the same, but everybody has a different way of doing it. And it's always interesting. It always helps. I think it always helps everybody to sort of understand how everybody else is doing this. And Yeah, I was talking to somebody else the other day who is trying to do. She's doing what we do. She's got money from one group, but she's trying to grow her business. And she was asking me, how do you do this, whatever. And I was telling her, she says, you're telling me a lot. I mean, we're sort of competitors. I was like, we're not. We're sort of all in this together to a certain extent. As I said, there are 20 million apartments.
20 million deals. Yeah.
You're not gonna. I don't think you're going to take my dream deal from me, and I'm not going to take it from you. So that's kind of the approach that we always have is try to be collaborative and work with everybody, and these are tricky times. So I think now that I'm old, when I was young, I was like, I know how to do it better than anybody else. But now I realize there are lots of people that have a lot of wisdom that can teach me more, even people that have been in it for a lot shorter period than I have. So again, appreciate you having me on, and excited to hear about what you're doing, and always love coming to San Antonio. So
all right, yeah, look forward to hanging out sometime. Maybe a beer, a cigar, a coffee. Like I told you earlier, I don't drink, but I do enjoy a coffee and a cigar. So maybe when you're here next time or at a property or something, go hang out.
Yeah, for sure, definitely. But look forward to it.
All right. Well, thank you very much, everyone that's listening. Go like, subscribe, rate, and review. It kind of keeps us going. We've just started hitting our stride. We're on 2-ish years, 200 plus podcasts, and the How to Build Wealth Like the 1%, the 5 Talents podcast is growing. So I'd really appreciate your likes and written reviews. Leave us a written review. I'd really appreciate it. It just kind of keeps us going. And go connect with Jon somewhere, and I'm sure he'd be blessed to hear that you heard him here. So thank you very much, Jon. Thank you, all the listeners. I'll talk to you soon. See you next week.